Hello, everybody. We're here to talk about how to adjust to rising mortgage rates. And so today I have just want to first welcome you all. This is Real Estate Investing Made Simple. And we do live interviews with experts and leaders in the real estate investing world. And I'm LeAnn Riley. I'm a realtor, broker, and a real estate coach, and I help people get started or scale a portfolio without confusion or fear with my proven profit formula coaching program. And I built a $14 million portfolio in residential, multifamily, condo development, commercial, and vacation properties. That's why I'm an expert. And I lead the Encore investment team of realtors here in the Twin Cities, Minnesota. And you can check me out on YouTube. It's under LeAnn Riley Real Estate. And be sure and subscribe if you get over there. So remember to stay on after the speaker today, because we actually do networking here on Zoom. And so stay here and you can meet the other investors. And if someone is also wanting a deal or has a deal, we can talk about that there at the networking. Okay, so stay on. So today again, here we are with Keith Bliss, and I'm going to introduce him first. Keith is with People's Home Equity, and he's a 23-year mortgage expert. He's a master loan originator, whether you're buying a home, an investment property, maybe refinancing, or you need some rehab money. And I've known Keith for over 10 years. I think that's right, Keith.
Okay.
And I call him my magic mortgage man. That's my secret, guys. But he's helped hundreds of people figure out the complexities of the mortgage market. And he's matched them up to the best product to get them a loan that works. And there is a matchmaking going on in this mortgage and real estate world. And the thing about Keith, he really provides the greatest customer service, and he goes above and beyond the call of duty. Believe me, I have stories, and he just takes care of you, and he will guide you to the finish line, no matter how hard it is.
Yep.
And I have sent so many people to Keith who the deal was falling apart, maybe with other realtors, or it just was not coming together. And Keith knows how to put it together. Much like me in real estate, we call it, this is our term, we say staple the deal together, because sometimes, honestly, that's what we're doing. And really, that's what a good realtor or a good mortgage person is, someone who can figure out the obstacles and then get it done. And that's what Keith does. So he's rescued many deals for myself and my team. And in addition, his company handles mortgages in any state. And so when I get out of state investors that want to invest in Minnesota, many times, especially in our multiple offer environment, it's important to have somebody local. And so it's nice to have a mortgage person who can work in all the states. So I'm so glad you could join us today, Keith. And gosh, such a hot topic. Especially today, the rates are up. So my first question is, we just got the inflation report today, and it's 9.1%.
Mm-hmm.
So how does that affect our mortgage rates?
Well, inflation is what's affecting interest rates, obviously, because the Fed is now trying to slow down the inflation. And the way you slow down inflation is raise interest rates. So in June, most people know the Fed took a 0.75 point rate increase, which drove the rates up to where they are right now. Excuse me. And they meet again at the end of June. And as LeAnn and I were talking before this started, there's actually a chart that I look at every day that they're speculating whether Chairman Powell will take the rate up 0.25 point, 0.75 point. Somebody on MSNBC actually said he might go a full point. But that's not necessarily going to slow down inflation. It's going to raise inflation because people are going to pay more for everything. So the strategy right now is not working, as the latest data that came out today showed. So
that's for sure. Okay, so couple logistics here. Before we get started, I want to take a poll of who is listening here. So it just takes like about a minute and a half here. I'm launching a poll. And those of you here on the call, if you can just make a quick vote, are you just getting started in real estate investing? Are you buy and hold people, fix and flippers, whichever strategy, it really helps us as presenters here to know who we're talking to. So I'm going to leave this up just for like another 10 seconds. We got some votes here. We've got, okay, I'm going to end the poll now. And you'll guys, I'm going to share the results right here. And what do we got? We've got some people who are just getting started, some fix and flippers, and they certainly have different mortgage questions. Buy and holders, somebody into student housing, and the BRRRR strategy. They're trying to rehab it and get some value. And then we got a good majority that are scaling their portfolio. So there you go. That's who's here on the call. And then the next thing I want you to know is the chat box over there is where you want to put a message, or if when we have Keith on, we may want to ask for some, you might want to ask a question when he's in the middle of telling us something, then go ahead and that goes in the chat box. Okay, so here we go. I'm ready with the questions. So we all know the mortgage rates are rising, but what's your opinion, someone who's been in the business a long time, on how much and how long?
So let's just go back a few months ago. Interest rates on a 30-year fixed mortgage in January was 2.875. Today it's 6.25. Many experts are predicting that 30-year fixed rate will get at or slightly above 7 before the end of this year.
Okay, slightly above 7 before the end of this year. And then, you know, I mean, you guys, somebody in your industry, do they project farther than the end of this year?
And we don't even, right now, we don't even like projecting till the end of the week. But
yeah,
the bottom line is, for the last several years, that has been what the discussion has been, is that rates were artificially low. The pandemic stimulate the economy. Coming out of the mortgage meltdown in 2008 and 2009, historically, they should probably be between 7 and 8%. But we've been saying that for 3 years, and something has always happened that's kept the rates down low. With our current situation and the inflation we're in, it's not realistic to think that they'll stay down. The Fed's reaction, until proved otherwise, will be to continue to raise interest rates.
Okay, but
it slows down buying, which helps inflation.
Yeah, it's all a cycle and they go together, don't they?
Correct. Yep.
Yeah. Okay. And we can expect, you know, I like what you just shared, because we would have been around 7%, but we had a pandemic and not all these other things. So we're trying to catch up historically here.
That's right. Well, if you go back as recently as I had a chart that I printed here, right before the mortgage meltdown happened, people were refinancing their houses left and right. And that was when rates were at 5.5%. So there was, the best way to put it, panic refi, because they were at 5.5%. I still remember the company I worked for at that time, and rates dropped down to 6%. And we did an enormous amount of business in a 2-week time period. I had the biggest month I ever had as a loan officer. I refinanced 40 people in 1 month. So I think we have to get used to the fact that where we've been for the last several years has been artificially low for a lot of reasons. People will always need to buy houses. One of the, I guess, if there's a bright side to what's going on right now, there's a lot of people that are first-time home buyers that have to get out of the market right now, because the combination of the price of houses, because of the shortage of houses for sale, and the interest rates, it is thinning out the number of buyers. So if somebody's an investor, they're probably not going to have as much competition as they have right now, especially for the $250,000 to $400,000 home, which, by the way, 3 years ago, a $250,000 home was a starter home. Now that's a $400,000 home. So
Yeah, it has changed. That is so true. So I'm hoping on this call, we can find out, what the heck are you recommending? Things are changing and we need to keep up on products. And I know the mortgage industry shifts or
Yep.
or our understanding shifts, and some products are better at different times depending on what you're buying.
Yep.
And how long you're going to hold it.
Yeah, I think one of the things too that we talked about earlier that I just want to clarify too, the interest rates are not necessarily what is changing. The rates are, let's just say for the sake of this exercise, they're between 6 and 6.25. If it's an investment property, they'll be slightly higher than that. What's changing is the cost to get those rates. Just about every rate that is posted on a daily basis has points or fees to it. There is a rate that's called the par rate. The par rate is the rate that has no hits to the interest rate. It costs the borrower nothing to get it. I have not seen a par rate posted in weeks because the market is so volatile, they don't know where to put it. So for example, I had a young lady, I have her screen up here, that's why I had to refresh it. She was looking at a house on Saturday. The interest rate was 6%. That was at a cost of $2,500. This morning, that 6% rate was $5,000 to get that rate.
Wow. In
This
points,
afternoon, it
right?
dropped to 20. What's that?
In points.
In points. And I'm not going to go into there's a percentage, obviously, but I'm just giving you the dollar amounts, and it's $2,700 this afternoon. So
Yikes.
that's what's changing daily, is the cost to get the rate, the points.
Interesting. Okay, and now what about the extra points then to buy down the rate? Is that a good solution?
I think if you're going to hold on to a property for a long time, obviously the interest rate being lower is to your advantage in terms of cash flowing the property because it lowers the payment. If your intention is to turn the property quickly, that may not be the best strategy. I did print off something here just to give you an example. On an investment property, someone with a 720 credit score putting 25% down. For the sake of argument too, I'm using a duplex because there are adjustments to the rate for a single family home to a duplex to a fourplex. But on a duplex, the rate as of a couple hours ago was 6.25. That would cost in points fees $8,160.
Oh,
Someone who wanted to go to 5.25, that would be $13,743. So there is going to be a cost associated with getting the rate, and the goal is to find the best rate at the lowest cost. That rate that I said, 6.25, that was the best rate that was posted today for us by my company for an investment property duplex. There was nothing higher than 6.25. So there's lower rates. There was nothing higher.
okay. But what if I called you and you look at the rates right then, and I locked in this morning at 6.25 with that with the $5,000 fee, and now I know it's 2,500. It's too bad I'm locked in, right?
Right. And right now we do have an extended rate lock program where it guarantees that if the rate goes down within a 90-day period, you would get the lower rate, but there is a pretty high fee associated with that as well. So that's not free when you get a rate lock without a property address, where you're basically locking the rate ahead of time. We do have that option to do that. And I don't even like quoting the numbers because those change daily, but I always present that as an option to people as well.
Wow. Like, how bad is it? 5 grand, 10 grand?
No, it's anywhere from 1 to 3% of the loan amount.
Ooh.
It's based on the loan amount. Yep.
Okay. Okay. No wonder I haven't heard of it.
Well, and it's a lot of that cost has to do with the volatility of the market. Is they hate guaranteeing a rate when we're in a rising rate environment, because it means that basically we may end up eating that rate. So
Now, what about, I'm thinking of car loans. They just made them longer. Will
Yep.
mortgages be 35-year mortgages or 40-year mortgages to kind of compensate?
Well, 40 is probably the more common, but 40 years would be what's called a non-qualified mortgage. So Fannie Mae, Freddie, FHA, VA recognize 30-year fixed rates at the upper end. There are investors that'll do 40 at a higher rate. There are also companies like there's one called Angel Oak that does 40-year loans. There are also banks and credit unions that have portfolio loans. The issue is a 40-year loan that's a longer term, you're going to pay a higher interest rate.
Oh, even higher. Yeah.
Oh yeah, higher than what I'm telling you right now. They will be higher. So I do a business with Angel Oak, and sometimes it scares me because those rates can get up to 8.5%, 9%, depending on the product that somebody's looking at. That is as of today. So.
And some people, sometimes for people that I don't see how that would work better, it's higher.
Well, and if you go to somebody where you have first-time investors and stuff that are on this call, it would be difficult in some instances to get a 40-year loan because it has a different criteria for qualification, has a different amount that you may have to have in reserves and stuff to be able to show that should something happen to you, instead of Fannie and Freddie generally like to see 3 to 6 months of reserves. Those loans may need 12 months of reserves.
Well, can you have a worse credit score to get those?
Generally, you're going to have a good credit score,
okay.
not necessarily a worse. So
that's not. Okay. And so today we're at 6.25, roughly.
Ballpark. Yeah.
How often do these change? Like, do they change 2-3 times a day or every day or week? Or
I wish they changed they change 4 to 8 times a day, depending on what's going on. So there are days like last Friday where the rates change 7 times.
Wow. So, you know, I was reading like maybe last Thursday and Friday, oh, the rates are going down. But did they? No,
they did not. One of the things that happened, many of the companies that are publishing those rates and stuff, those rates are reported to Freddie Mac or Fannie Mae. They're generally a week old. So by the time it hits the newspaper, the rates that are being posted could be 7 to 10 days old. That being old wasn't necessarily a problem until we got into a rising rate environment. And every time I saw last Friday that somebody said that the 30-year fixed rate was 5.375. Well, it hadn't been 5.375 in 2 weeks, but the data was so old that by the time it was reported in the newspaper, it made it look like there was a significant rate drop. That did not happen. Last week, as a matter of fact, rates went up all week long. And I have to go back to it. The cost to get the rates is the rates have pretty much stayed stable at around 6%. It's the cost to get the rate that has been changing.
That's amazing. And that makes me think of the real estate market. You know, if you look at certain websites, like let's take Zillow, for example, it is not real time the same as realtor.com.
Correct.
And you might look over there and see one thing, and then the client will call the realtor and say, hey, I want to look at that house. Well, it's long sold. Yep. They just don't have it over there. So same thing, you got to look at the right data.
Well, not only do you have to, looking on websites and all the rest of it, one of the things, there's a publication that I get twice a day. And one of the things it talks about is most people, and it's human nature, you fixate on the rate that you see on a website. You don't read the fine print about how much the points are to get the rate. There's always a cost to get. I mean, like you could get, for example, on that scenario 720 on an investment property duplex, you could get the 4.99% if you wanted to. The cost is $15,468. You can always get a lower rate if you have the financial ability to pay the points. And that's always something that has bothered me as a loan officer, is I always send people what's called a loan cost estimate. It's a breakdown of the fees. And they'll tell me, well, I got a better rate from somebody else. Well, send it to me and I'll take a look at it. And inevitably, it usually is tied to some type of fee to buy that rate that they weren't aware of, that raised the total amount of their closing costs. That I was telling them they had to bring $3,000. Somebody else told them they had to bring $12,000. Looked like somebody had a question.
Yeah, it is. I'm trying to see the whole thing, but I'm there maybe. So it's Brandon here. The first 10 years of interest only with no principal reduction is scary, yeah. Followed by a traditional 30-year mortgage that you still have to qualify for, especially with the average length of home ownership being 7 years. That is so true. That is something people don't realize. The average length of home ownership is 7 years.
Yeah.
So we're going to hit that here in a minute, Brandon. So what, how about putting more down payment? Does that like somehow help the rate or no?
Yes, it does. Excuse me, I have a dry throat. Anyway, two things that will affect the rate are credit score, obviously, if you didn't know that. If you have a 720 score, you'll get pretty good rates. If you have a 740 score and above, you're going to get the best rates. The more money you put down, the more impact it will have on the interest rates. So it's not a mortgage term, but the more skin you have in the game, the more aggressive the lender is going to be with interest rates. So somebody who puts 30% down instead of 20 is going to have a better rate. Matter of fact, if you put 31% down and you're below 70% loan to value, that's where you see the best rates.
Ah, that's an interesting
So,
one.
yep, the more you put down, the better the rate will be.
Okay, so that brings me to the big question of the person with the average home is 7 years. Then what about ARM? Help explain how the ARM works.
Well, let's go back to Brandon's thing there. So I am not a big fan of ARM. So when Brandon made his comments, first 10 years of principal and interest, blah, 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 and then you go to a 30-year fix. That's what happens with an ARM. Right now, there are 5-year ARMs, 7-year ARMs, 10-year ARMs. So in theory, you would get locked at a lower interest rate on an ARM than you would on a fixed rate. Follow me there. Today, that's not the case. The ARM rates are not as good as the fixed rates. The other issue would be is that at the end of that ARM, if it's a 5-year ARM, the rate can adjust every 6 months. You'll go to whatever the adjustment is, and who knows what that's going to be, because the adjustment's going to be based on a number of different factors. It could be the rate goes up 1%, 2%, 3%, but it'll keep going up every 6 months for as long as you have that loan until it reaches a maximum point. And I don't know what the exact rate is now, but the last time I checked it, 18% was the cap that someone could go to on an ARM. Again, wow. The rates are changing so quickly, but I did look at, I had an ARM here that it was a 5-6 ARM, so fixed for 5 years, 5.125, and then it would adjust every 6 months. The cost to get that rate at 3 o'clock this afternoon was $12,111.
Now, did that shift from 2 weeks ago or something, or
this just happened, and this all has happened in the last couple of weeks. ARMs are not something that have been very good. I'm trying to choose my words carefully. The rates have been so low for so long, and ARM really didn't serve a good purpose. Now that we're seeing rates change the way they're changing and the inflation and all that it's affecting the rates, ARMs are not something that a lot of investors want to do. So you can do an ARM, the cost is not low, and the rates are not going to be significantly lower than a 30-year fix. The scary part about an ARM is that when that ARM runs out, if it's the end of 5 years, you face a couple of issues. Are you just going to go ahead and eat the increases every 6 months, or try to refinance it? What's going to be the rate at the time you refinance it? It might have been better to have had a 30-year fixed and kept it that way long term.
Yeah. But maybe if you only plan to own the property a couple of years, but if it's comparable to the 30-year rate, why pay more?
Well, and that's the thing, is that in this instance, the scenario I just gave you, it is a point lower than the 30-year fixed, but it costs $12,000 to get it.
Yeah. Ooh. Oh, wow. Back I did ARM on properties I bought, but back then we could choose if it was going to adjust 1 year or, in 2 years. We could choose some different options about when it adjusted in. There was the ceiling was not very far from where we were at, like 1.5 points, maybe 2 max.
Well, in my brilliance, when my kids went off to school, my wife and I refinanced our house and did an ARM, a 5-year ARM that when the rate was 2.5%. Then it started adjusting and we eventually refinanced a couple of years ago back to a 30-year fixed because we were up to 8% after the adjustments.
Wow.
And it was in the mid twos, but the adjustments started happening and the rate just got out of hand. We're lucky because of the pandemic and all the other things that kept the rates low. We were able to get a good affordable rate. I'm not so sure in this environment that you can look at it and say that 5 years from now, the interest rates will be lower than they are today. I printed something off and I had sent it to you, but if you go back just as recently, and this, I'm going to say it's recently, we've had rates that were anywhere from 10% all the way at its lowest rate in the mid 9s as recently as the late 90s, early 2000s. What affected the mortgage industry the greatest is in 2001 through 2007, rates were extremely low. There was very little guidelines. Anybody could get a loan because we had 2 presidents that thought everybody deserved a home. So rates came down and they were in the mid 6s and 7s. Then people started dropping the rates, doing adjustable rate mortgages. In 2003 to 2006, they got down to in the mid 5s, and people were using their house like an ATM and refinancing them. And almost everyone was using adjustable rate mortgages. Then we had the mortgage meltdown in 2008, 2009, the value of properties dropped. And all of a sudden, people couldn't refinance their homes. And we had the colossal thing where the banking industry almost collapsed because of all the bad mortgages out there.
That is so true. Woo. And we're not in that same sort of debacle. And what people, I've been in the real estate business for a long time. I got 18% mortgages and didn't think twice.
Yep.
And the reason is, and that's in the late 80s and early 90s, because my property still cash flowed. Yep. And that's what it was about as an investor. Does it cash flow? Yes. Okay. I don't care if the rate's 18%. But, people who are just new in the business, they grew up on low rates and they think this is outrageous. And we have to just learn to compensate for it.
Well, people will always buy homes. There will always be mortgages available. But you are absolutely correct. We have to adapt to what the industry, the mortgage industry, and Fannie Mae, Freddie Mac, FHA, VA, USDA, all those entities are the ones that set the rates. I don't think people realize it's not a lender who sets the rates. We all get Fannie, Freddie, and FHA rates from the same place. So.
Well, and, I guess some people say, well, is an ARM risky? Should we be concerned? What's your answer?
I think an ARM is very risky. And I see Brandon put up another comment here. Everyone wants a fixed rate in a rising rate environment. Everyone wants a variable when they're declining. That's probably true. I have not been a big fan of ARMs since the mortgage meltdown, because that's what caused a lot of people to lose their houses. They went with the super low interest rates. I had one investor who had 21 houses I helped them finance, and he lost all 21 houses because he couldn't refinance them fast enough when the rates started going up. And this was, again, 2010, 2011. He could not qualify at the higher interest rates he was going to have to pay. Yet he also couldn't keep affording to have the rates increase every 6 months because he was renting them. He couldn't cash flow the properties because he couldn't raise the rent every 6 months. So the fixed rate gives you the stability of knowing what you're going to be paying. The only thing that's going to change on a fixed rate mortgage is going to be your taxes and insurance, but you can build that into your rent. The goal is to make money on the investment property, not lose money. And I think that's hard to do with an ARM. That's my opinion.
Now, what's the lowest credit score someone can have to buy a house?
An investment property or just a house?
Even a house. Anything.
A primary residence, you can buy, FHA goes down to 580.
Okay, they do.
You can do that. And also Fannie Mae and Freddie Mac have 2 products that will go down to a 580 as well. FHA is, I'm not going to say easy, but FHA at 580 is a loan that's much easier to get than a conventional loan at 580. Everything that I have a comparison chart because Fannie and Freddie are bragging to everybody that they go down to 580 now, just like FHA. FHA doesn't have the same qualifications at 580 that the conventional loan has. So, but that is the lowest credit score is 580. Realizing if you buy a house with a 580 credit score, you're also going to pay a higher rate because rates again are tied to score.
So 580 is the bottom, and otherwise you can't get a house unless you have a cosigner. And 740 and above is where you want to be up there.
Correct. You can get an FHA mortgage with less than a 580 score, but then you have to have a significant down payment. So FHA technically will go all the way down to a 500 with a 10% down payment, but most people that have a 500 credit score don't have $30,000 in the bank, but technically it can go down that low.
Wow, that's amazing. I didn't know that. So now that you're telling me an ARM is risky, I'm scared for my investors. So what do you see changing for investment property? Go get a commercial loan, call Brandon, right?
Well, that's one way to do it. I don't know what Brandon's rates are, but I believe that most commercial loans are going to have a balloon payment on them, and then you're going to refinance them on a commercial. They're not 30-year fixed. I guess I'm giving my personal opinion. In today's environment, it makes more sense to get a fixed rate than it makes to get an ARM. That's, I guess, the bottom line.
Yeah.
And I think you're going to end up with an interest rate that may be slightly higher, but you don't have to be concerned about it changing 5 years from now, 6 years, 7. The ARM rates that we quote are 5, 7, and 10. But as you go up in the number of years, the interest rate also goes up too.
If you plan on selling in 5 years, it might be less risky.
It could be. And that is, again, something that somebody has to put into it. Like you said earlier, the average first-time home buyer stays in that home for 7 years. The average investor holds onto that property for much longer. I don't have that statistic, what that is, but most people that are buying investment properties that I know are using that as a retirement hedge, that they know that it'll cash flow, they'll make money on it, set that aside for retirement. And then when they get ready to retire, they sell it and hopefully make a significant amount of cash on top of it. But most of the people I do investments for, I ask them how long they plan on keeping it. And depending on their age, most will tell me 15 to 20 years.
You know, that's very true. And I teach investors that, you actually make your money on the buy because you know your whole plan. If I know I'm going to keep it for 5 years, because that's my plan and I have a reason or whatever, then I'm comfortable with the ARM. If I plan on 15 years, that's probably not a good plan.
Correct.
Just like you said. Yeah.
Again, the big thing is most of the ARMs that we see right now today will adjust every 6 months after the initial adjustment. And there's several different factors that affect that adjustment. So it's hard for me to tell you right, but the interest rate will continue to go up unless you refinance out of the ARM. And
Eric is asking that. So really, if you look from all your years of experience, it sounds like you think mortgage rates are going to continue to rise.
Yes, I do. But Eric's question, so it sounds like I think mortgage rates will remain high for a long time. They're not high in comparison to the last 40 years. They're high compared to where they've been for the last 5 or 6 years. But if you do a historical comparison, even where they're at today, they're low rates.
Yeah, it's not high.
Remember, back in the 2005 to 2008 period, if someone could get a 6.25% interest rate, they were jumping on that because they were probably in double-digit interest rates from buying their house in the 90s. So the rates are higher than where they were historically. They're not anywhere near where they've been.
Very true. Very true. Okay, so as far as an investor loan, are parameters tightening, would you say, or they're pretty much the same? You just got to fit in the box.
Yeah, the parameters haven't really changed. If anything, they've become more aggressive in terms of underwriting. And with my company, Fannie Mae, Freddie Mac, FHA, VA, USDA all have their guidelines. we all use automated underwriting that tells us whether or not a borrower is qualified. Whatever that underwriting decision is that comes from Fannie or Freddie's automated underwriting, that's what we follow. There are many of my competitors, banks and credit unions that do something that's called overlays, which there are things they put on top of what Fannie, Freddie, and these other people say, and it makes it much more difficult to get the loan. I do a lot of FHA loans right now because FHA is good for a lot of first-time home buyers. I can do a FHA down to a 580 credit score without naming the banks. There are several large financial institutions that their minimum score is a 660.
Ooh,
So,
that's a huge difference.
right, and that's not FHA. That is the bank, the credit union, or the lender. That would be a good example of an overlay. Most of the people that I compete against are at 620 to 640, but still, if somebody has a 580 credit score and they have the ability to make the down payment, FHA says they can get a home.
Well, you know what? That's why you've been able to rescue some of these deals for me, Keith. Or sometimes I know I've sent you several tenants. The landlord wants to sell, the tenant wants to buy it, and they've never even thought about buying a house.
Yep.
And I send them to Keith, and all of a sudden the tenant is buying the house, and they had no idea they could even qualify.
Well, and the big thing that a good mortgage person does is they're going to give the buyer options. So sometimes, excuse me, I wish I'd get rid of that cough. There's a loan, USDA, United States Department of Agriculture. It's not a farm loan, but USDA is trying to help develop rural areas. USDA requires 0 down. They are pretty tight with their guidelines in terms of debt ratios and stuff, but depending on where someone's looking, USDA might be a good fit. FHA works for a lot of people, but if someone is borderline, that if they did a few things to tweak their credit, build up their assets, straighten out some things that may show up on their credit report, if they're borderline commercial, I may work with them to get them to the point that they can get a conventional loan. So the idea is to give people options. It's not really a cookie cutter environment. I have very few people I deal with that don't have options, and it's up to them to decide on what they're going to do in their financing, not me. So,
you know, that USDA.
yes.
So let's say somebody wanted to buy a house in Faribault. Is that USDA territory? It's not in the Twin Cities. Is that considered rural, or are we talking farm country?
No, it's not farm country. So I do a lot of business in the northern suburbs. I believe Faribault's in there, but I have a tool that if somebody's looking at a house in Faribault, I punch in the address and it tells me whether or not it's eligible for USDA financing. The closest place I know for sure that's all USDA is Isanti County, Cambridge, all of that area up there. So basically nothing in the 7-county metro area would be USDA. And when you get outside the 7-county metro, then we have to go in and punch in the address, and USDA has a tool that tells us whether it's eligible or not. Okay.
And does USDA work for investors?
It does not.
Okay. It's only owner occupied
first-time home buyers. Yep.
Okay. But 0 down.
0 down.
That's attractive.
Yep.
And maybe somebody's looking for a house in East Bethel, and if they went 5 miles north, they'd then be in Isanti County and they could get a USDA loan.
Right. And there is nothing that says that after someone's lived in a house for 1 or 2 years, let's say they're that average first-time home buyer, they can keep that house, use it as an investment property, and buy another one. Yep. So that's what a lot of people do with FHA is they use the FHA financing to get a house. A year or two, they decide to move on to another house. They rent the house out with the FHA mortgage. So
I love that because then, you know, that's a great way for people to get started. Now, talking about FHA loans are assumable.
Yes, they are.
So now explain. So we found that rental property you're just talking about and want to buy it, and they have an FHA loan, and maybe we can't qualify for a mortgage. Can we assume theirs?
Well, they still have to qualify, even though it's assumable, they still have to meet the qualifications at that time. But obviously, the advantage to selling a house with an FHA mortgage based on, again, today's environment, the rate may be significantly lower if someone buys that house from someone 5 years from now. The rate could be significantly lower than what they'd see 5 years from now.
Okay, because that's one of the things a lot of people don't know about is that FHA loans are assumable. And
It's still
sometimes
the only
that
product that is.
that's a new thing to look at as a possibility.
Mm-hmm.
Does that work on investment property too?
Well, on an investment property, I've never run across that because most people that buy an investment property for FHA, if most of the folks on this call don't know, if they're a first-time home buyer, you can buy a duplex up to a fourplex with an FHA loan as long as it's owner occupied. So you have to live in one of the units. Would that still be assumable? It's an FHA loan. I would have to assume it's assumable, but I've never run across that. So,
Well, you know what, Eric, he's one of the agents on the Encore investment team. Eric just ran into one of his clients who is doing an FHA assumable loan on a triplex.
yep.
And he's must be moving in because then he'd be owner occupied
Yep.
too.
Well, that's
So-
the key. It has to be purchased as an owner occupied property. You cannot buy it, use FHA for a straight up investment property. You buy it, you live in it, you can rent out the other side. And with certain documentation, you can use the rent that's being received on the other side as income.
Okay, now can you help people who are wanting to buy short-term rentals?
Define exactly what that is you're asking.
Well, they're going to buy, well, I know that you can help them if it's a vacation home, second home. But if they go to you and say, I'm going to buy an Airbnb, here it is, can you help them?
I'd have to see the specifics of it because there are going to be guidelines to that. Basically, my company is flexible. We'll look at almost anything. There is no prepayment penalty or anything anymore. So if somebody buys an Airbnb and decides 9 months later they want to sell it and move on, there's nothing that says they can't do it. When we do a mortgage application, we're not asking somebody how long they're going to keep it.
That's good. So none of these arms have prepayment penalties either.
No, the prepayment penalties are not legal. Yep.
Thank
On a
God.
qualified mortgage.
Except for on commercial loans, if you might have a step
There are
down.
certain types of loans that you would use to acquire a property that still would have prepayment penalties, but residential mortgages do not.
Okay, and then what about rehab loans? Does your company help people if they needed say they were buying like a 203K, you know, a
Yes.
property that needed $20,000 of repair and then you build it into the mortgage, you can do that?
Yes, we can. And there is a product that is called Home Style that is a Fannie Mae product that's also a rehab loan. And obviously there's a lot of work that needs to be done because you get the price of the house, then somebody goes out there, licensed contractor, gives bids on what it's going to cost. And yes, that can be worked into the mortgage. And the loan amount can be based on what the value of the project will be after completion. There are timeframes, though. You can't take out a renovation loan and say you're going to take 5 years to finish it. Most of them want you to start the work and complete it within a certain amount of months, 3 to 6 months. That is sometimes flexible now because of the shortage of manpower that they may extend that. But the person, when you do a renovation loan, the money that'll go towards the renovation is generally put in an escrow account with the title company and it's dispersed by the title company. There was a time that people, when they did a renovation loan, if they got $50,000 for the renovation, they got it and they may never do the renovations. They'd run away with the 50 grand. So now it's held by a title company and
That
they
makes
disperse
sense.
it as the work is done.
So here's what I'm hearing, Keith, and I already know this about you. I don't care how complicated the person is, the possible buyer. If they call you, you help educate them on what could work for their situation.
I hope so. I had a young lady that I just said, a lady called me 2 weeks ago, said she wanted to go out, first time home buyer, wrote a contract on the 10th. I got the purchase agreement on the 11th. It got cleared to close 2 hours ago. She said
That's
that if she would
fast.
have, yeah, it is fast. She said if she would have known that I was going to call her so much, she would have blocked my phone calls. And then she laughed. But the goal was to educate people and help them through the process. You don't hear from me one time and then there's a void. Eric and you both know there's probably more stuff that you want to know that I'm going to tell you. And the goal is to not just walk people through the process of starting the purchase, but as the purchase goes along, explaining what's happening and why, and helping people understand it.
Totally. And people do dumb things sometimes in the middle of purchasing. And I know you've helped get people out of those jams when they buy the furniture 2 days before the closing. You can't do that.
Nope. Nope. Don't buy furniture. Don't take out new credit cards. Don't buy a new car. I had one guy that I've helped now buy 3 homes in the last year. And one of the things he told me is that his daughter needed a car. And I said, well, how big is it going to be? And he said, well, she just wants a 4-door car. She's going off to college. I said, well, is it big enough to live in? Because it might be the thing that pushes you over your debt ratio. So if she needs a car, can she wait a week or two? Because the day you close, you can go buy the car, but do not be doing that during the loan process.
Yeah. Okay, and then, what about interest only loans? And Brandon said something about that. And, I used to do interest only loans, particularly if I used a hard money lender. Do you have them?
Yeah, interest only is available. Again, I think one of the things that Brandon talked about, though, is if you do interest only for a certain amount of the loan, then you haven't paid off any of the principal. Then you have to pray to the good Lord that the house appreciates, so that if you do need to refinance it, there's enough value there that you can get a regular principal and interest loan. Yep.
Okay. And then refinancing, I mean, you had a big boom and now it's going down, right? It's not,
correct.
It's pretty clear. So what are the fees generally on a refi?
If you just do a straight up refinance, the interest rates are probably going to be very similar to when you do a purchase.
Okay.
There aren't, and again, it's loan to value. If you're less than 70% loan to value, so your house is worth 300,000, but your refinance is going to be 210, you're going to have good access to rates. The higher the loan to value, the higher the interest rates will be. If you want to pull cash out, which a lot of people were doing, there are adjustments to the rate when you take cash out. And again, that's based on credit score and the loan to value. How much is the loan compared to how much the house is worth?
Here's one of the things I've been telling my investors, rents are going up because we have this shortage. It's very clear. And people who are griping about the interest rate, I say, hey, the rents are going up, and that increase in the rent should cover that increase in your interest. So you still cash flow, but you got to be brave and you got to get the market rents. Don't be timid and be under the market rents. You have to sort of take advantage of this time to push those rents.
Yep. There is not just, and it's still to this day right now, there's still a shortage of houses out there, houses for sale. That same situation is with rental properties. There are a shortage of rentals. You're not going to want to gouge somebody, but to your point, look at what the market rent is. And I know you have tools to do that.
Yep.
You do not think you have to give somebody a good deal or to look at it and say, well, my payment's only $1,000. The market rent is $1,600. I don't want to make $500 to take it to the 1,600, charge what the market rate is. So
that's right. You can.
Well, and you're not going to have problems getting renters, just like people are not having problems. People are not having problems selling homes. I recently had someone that I worked with that sold their house and they're going to buy another one. And they said, I couldn't believe it. My house was on the market 19 days. 19 days is an eternity for the last few years. But most houses were selling 1 or 2 days. You had an open house, 2 days later, they were inundated and the house was sold. So, but houses still are selling. People still want to buy. People still need nice, affordable rental properties until they can afford to buy their own home.
Right. And now, right right now, because of the great appreciation we've had, people are taking out HELOCs or refinancing for
Yep.
cash out, and then they're buying more property. That's what's been happening. That has, and there isn't enough inventory, but already I can see a huge difference in investment property, just duplexes, triplexes, fourplexes. It's already loosening everywhere.
Yeah, there's
But
less competition right now for sure.
that's right. It's a good time to buy, and it's still a very good time to sell.
Yep.
And so people are leveraging is what my point is, because we said we'd answer that question. These rates aren't going to stop people from leveraging and buying more properties or getting the home they love, all of that. And, you know, I just wanted to share with you the vacancy rate right now in the Twin Cities is 3.6%. That is low, folks. Super, super, super low. And it's not going to jump up there anytime soon.
Yep.
So, okay, now what about that darn job report that came out just a few days ago? And it said that they came up with 372,000 new jobs. How come that means the rates will rise? And I was like, well, good, this is good, a good job report. And now they're saying, yep, but the rates have to go up.
It's inflation. In a normal time, a good job report, not normal time, for the last several years, a good job report, anything that showed good news for the economy would have a positive effect on interest rates. Right now, this is all about inflation. That's plain and simple. You could go into all the different theories, but we're in not a good situation with inflation. That's the cause of interest rates. These other factors all are positives, but we still have to slow down people's spend. We don't. The federal government has to slow down people's spending. That's why interest rates keep going up.
And, you know, okay, so people who do have credit scores on the edge, you know, what do you recommend?
Well, typically, and I'm not a credit advisor, but there is I have a program in my computer that's called Rapid Rescore that generally, if people are on the borderline, Rapid Rescore will tell me what they can do to improve their credit score. And if they're able to do those things, it can be done in little as 72 hours to raise somebody's credit score. And I've had several people lately that I've gotten their scores raised 60 to 70 points. So
What's an example of something? You mean pay off a credit card?
Paying down a debt, getting rid of a bad debt. Most people that they have credit cards that they're 100% of the available limit. It generally, if you're at 30% of the available limit, it's going to have the maximum effect on your credit score. The issue is that if you do that on your own without the Rapid Rescore, it could take 60 to 90 days for that payment to be reflected. If someone pays that debt down to the 30%, and I get proof of that, Rapid Rescore allows us to send that into the credit bureaus, and it's immediately rescored within 72 hours.
Wow. See, there's a lot of little ways you can help people is what I see. And, you know, it's great to have a little program like that. I'm thinking of my daughter when she was young and she had no credit. I remember Credit Karma told you which credit card to get, where you paid them the money and then you got the card. But hey, it's a good way for someone who doesn't have credit to start. And then I told her, just pay for your gas with that. And then, you know, you're paying ahead. That's all.
Well, that's good advice. I mean, that I was, because of the industry that I'm in, I did the same thing you did. I told my kids, get credit cards, pay for the gas, whatever you want, but at the end of the month, pay it off.
Right.
There are other people that got the credit cards, ran them to the max, and then kept getting new credit cards to replace them. That wasn't positive.
No.
Then there was another school of thought that young people's parents told them, don't get credit cards or you'll never get a house. Well, you can't buy a house if you don't have credit. You can't get credit if you don't have credit cards, car loans, and all the rest of it. It's the responsible way you manage it that affects your credit score. You can't have a score without having credit. So,
you know, I got to tell you the funny story. My son, so I explained that to him. He went out and got his credit card, but he somehow thought if he charged $18 worth of gas, then he would go online and pay off the $18. And he did that every purchase until the bank finally called him and said, you can't do that. You can't do it that way. But guess what? His credit score shot through the sky.
Oh, yeah. Well, I told my kids, just pay it for the month, and when the bill is due, pay the bill off. That's what helps. But paying it immediately after you use it doesn't usually help. So
No, it was funny.
that's not managing credit. And that's
I
what the
didn't even
bureau
know he
scores.
was doing it until he said the bank called.
Yeah.
So, okay, cool. Anybody got any mortgage questions, you people on here? This is your shot to ask Keith. I know he answered a lot because Eric and I really put this together so we could ask you everything we were thinking of that we wanted to know the answer to.
Yeah.
So put it in the chat. And otherwise, we're going to move off to our networking part. I think I asked all mine. Eric, you got any more? I know he's listening here. He did a lot of the research. You know, not right now. He says, okay, I had two more on here. When you close on a loan, they call it the APR. What is that?
The annual percentage rate. The annual percentage rate is not your interest rate. It's the interest rate plus any fees that are incurred in the loan, closing costs rolled into it and expressed as a percentage. It's
so
the
that's
cost of the loan.
That's that ugly number you see when you're when you're signing your papers. It's this giant number, way bigger than what you're buying, right?
Oh yeah, but it doesn't affect your payment. What it's basically telling you, it's the cost of doing the loan.
The whole thing for the 30 years. And it's scary, you guys.
Yep.
Okay. And what about cash out refis? Is any of that happening now?
It is. It depends on people's financial situation. Again, all interest rates are being affected. So people may not want to use a credit card for if they need to make a large purchase. Their house may still be the best way for them to get cash out to make a purchase.
Yeah.
Like you said, if somebody's investing in a house, that using cash out from a refi may be the best way for them to get started in investing.
Yeah, in the next house. Yeah. And our HELOCs run a little bit different as far as their rates.
Right.
I'm talking home equity lines of credit, not where you take the cash, but you get it in case you're going to remodel or whatever.
Sure. And a HELOC, the rates will be, can be slightly lower than a mortgage, but they're also, the payback is much quicker. They generally want the payback within 10 years. And going back to Brandon's original point, a lot of HELOCs only collect interest on their payments.
Yeah.
So when they're due at the end of 10 years, you owe the principal and interest of the original loan, unless you set it up to make a separate payment against principal. So a lot of times HELOCs, you're only paying interest, you're not paying against the principal. At the end of the period, you owe everything you borrowed.
They can be useful though to get,
yes, they can.
Especially for investors, or rehabbers might use a HELOC
to
get through it. Or people even selling their house right now and they got to do a little bit of fix up and they don't quite have the money. Go ahead and do it that way and then get it fixed up, get more for your sale and pay it off.
Yeah, and the best, then I'm obviously, I now do HELOCs too. We have a company we work with, but I will tell you that a lot of people don't really, credit unions are a great source of getting HELOCs from. They generally have real good terms and lower interest rates. A lot of people run right to their primary bank, and depending on which bank it is, they may not be a good a value as going to a credit union and joining the credit union for the $5 savings account you have to open and having access to the HELOCs they offer.
Okay, and now I'm going to put up for you, this is how you can contact Keith right here. There's a picture of him and that's his phone number and his email there. Eric, can you put that in the chat for us too?
And I would like to mention too, that phone number is my cell phone and I answer that 7 days a week from 7 a.m. to 7 p.m. So I always tell people, if you can't reach me, you're not trying, but that's my cell phone. That's the number I use because it's always close. And if you have a question, call me or text me and I'll generally get back to you within 30 minutes.
And he does, you guys. And as a realtor, that's what we love too, because once you know it, somebody wants to buy a house on a Sunday. And you know what? We can't make a good offer unless we have a pre-approval letter. Right? And we
Absolutely.
can get one out of Keith
Yep.
on a Sunday. Okay, I got one more thing here I want to share. I do free strategy sessions. If you want to chat real estate with me, investment property, whatever, buy, sell, invest, right there. You can go to my LeAnnRiley.com, go to the coach section, and you'll see a bunch of buttons. You can get a free strategy session. So I'd love to chat with you. We got some people in the chat box with some questions. Oh, okay, that was him putting in, somebody had a newbie question. How does all of real estate investment financing activity impact your credit on an ongoing basis? Will your credit be negatively impact substantially if there are multiple hard hits on your credit every time you want to finance an investment property?
Okay, so a mortgage inquiry is not looked at as being a hard hit. It's a soft hit. Back during the Dodd-Frank legislation that happened after the mortgage meltdown of 2008 and 2009, the federal government actually did legislation, and part of that was to encourage people to shop interest rates. So shopping an interest rate for a home mortgage has less impact on your credit score as a rule than if you went and opened up a Target credit card. So, and then once you have the loan, making the payments on time and the payments for what they're supposed to be will have a positive impact on you. But that's one of the great misnomers. People think that a mortgage inquiry is a hard hit. It is not a hard hit. The credit bureaus see that it's a mortgage company doing it. I've seen people that have shopped their mortgage at 3 or 4 different places, and it hasn't had any effect on their credit score. As a rule, if it has an effect at all, it's usually 1 to 5 points. There's no guarantee of that, but again, it's a soft hit, so you shouldn't have to be concerned about that.
And if you are going to shop mortgage rates, I always thought or heard, as long as you do it within a 5 or 6 week period, you're okay. But what you're saying is mortgages are soft hits.
Right, but it's still better that if you're going out to look for a loan and stuff, I always tell people try to do, if you're going to do multiples, that's your choice. Do it within 3 days of one another.
Okay.
But I've seen people that another devastating thing to people that they don't realize, if they go to buy a car and they go to their local car dealer and they want to get the best interest rate, I've seen people that their credit has been dinged 50 or 60 points because the car dealer sends out a mass message to 11 lenders, and all of a sudden their credit score drops because it looks like they're buying 11 cars. So it doesn't work that way in the mortgage business. They realize, the credit bureaus realize your shopping rate and terms.
That's
but
cool.
I wouldn't recommend shopping rate and terms with 11 different lenders. But if you feel the need, I always tell people, if you want to compare me to somebody else, go ahead. I encourage that, because I don't think anybody will do what I will do to make you happy in getting your loan. My business is based on referrals, and I've been in it for 21 years. So
all I know is, like I said, I call Keith my magic mortgage man. Just, you better call Keith. And if anything isn't working, he will figure it out, or he'll tell you why it won't work and what you can do to fix it in the near future. And a lot of people do that.
yeah, and that's another important part. Even if you know you're not quite ready, and I have several people I'm working with right now, if you know because of credit or not having a down payment or whatever that you're not quite ready, we should still talk. And like LeAnn says, she'll do a free strategy session. I'll do a strategy session too and tell you what to do so that 3, 6, 12 months from now, you're ready. Most people have no idea what they need to do to be ready.
Yeah.
So they're no better off 12 months from now, because they're doing the things that aren't positively impacting their ability to buy a home.
So true.